Firstly, the disclaimer. Nothing in this video is intended as financial advice. Please pause the video and read that disclaimer in full. And remember, everything in these videos is simply my personal opinion. Security tokens can represent anything of value. Shares in a company, bonds, derivatives, artwork, literally anything of value that can be traded can be represented by a security token. So when we talk about security tokens, it's certainly not a niche thing. It is a very, very broad category. There's one category within which I think is going to be particularly big over the next few years, and that is companies looking to sell their shares via a security token and essentially raise money in the early stages of their company to finance that company. Now, if we take those words, I've pretty much described what venture capital is. It's early stage company investing to finance your company. Therefore, we can't really look at security tokens and say this is good, this is bad, or have any basis of comparison unless we first understand venture capital. That's why over the coming months, I'm going to be talking more and more about venture capital because it is so important to understand when you're looking at security tokens. And for that exact reason, in this video, I'll be covering the 3 biggest issues which I believe venture capital has and how security tokens are capable of overcoming them. So let's jump straight in and talk about what are these 3 issues. Issue number 1 is the high minimum. To invest into a venture capital fund, you usually have to put in at least $50,000, and realistically, it's usually $100,000 or $200,000. For the regular person, you or me, this is beyond impossible. Therefore, it's a significant barrier to entry for us. Issue number 2 is the lack of liquidity of the fund units. So basically, you could invest into the fund and it could do fantastically well after year 6. You might be being told by your fund you've made 20 times your original investment. But because you don't have liquidity, you cannot sell. Therefore, it's perfectly possible for all of the companies that the fund owns to crash in value and you end up at year 10 having lost all of your money. At year 6, you were doing brilliantly, but you couldn't sell. Year 10, you suddenly lost it all. Wouldn't it have been amazing if you could have at least taken some of your profits? This is what liquidity provides. And number 3, we have no liquidity within the portfolio. So generally, when you take a venture capital fund, they invest into early stage private companies, which are themselves incredibly illiquid. As a result, the fund generally doesn't have the option to take any profits on those underlying investments either. Now let's talk about how security tokens can potentially overcome these 3 issues. Number 1, the high minimum. Technically, it has always actually been possible to collect money from smaller investors and, depending on the jurisdiction, retail investors as well. But nobody ever really did it. The reason is that it's relatively expensive and time consuming. With blockchain and security tokens, you gain several efficiencies, which means that while nothing has technically changed to make it possible, if you take away the barriers, suddenly what was possible but unrealistic becomes feasible. Therefore, we could see many more venture capital funds in the future have significantly lower minimums and allow retail investors in. I don't expect this to realistically exist within the next 6 months, but I do think it is possible in the future. And the other really cool thing here is that if a venture capital fund decides it only wants accredited investors to invest during day 1, their fund units will be tokenized in the future and listed on a security token exchange. If that happens, it is possible for people like you and me to go to the secondary exchange and still buy into that fund, even if they didn't allow us in during day 1. Number 2, no liquidity in relation to the fund units. A fund unit is essentially a share within the fund. So if you invest into the fund, you get a fund unit back, which says you own a portion of it. Nice and simple. Now, usually there is no liquidity with your fund units. And that basically means that once you've invested, You cannot sell out until the fund has closed. In traditional venture capital, that is a 10-year window. Imagine right now seeing an amazing investment, but being told at the same time that you won't be able to sell it for 10 years, a whole decade of your life. It might be an amazing investment, venture capital usually is, but you're probably not likely to invest into it because a 10-year lockup is pretty crazy. You also have the other issue which I mentioned earlier, and that is, what if the fund is doing brilliantly after 6 years? It's suddenly up here, but you can't sell your tokens. Therefore, when it crashes in value at year 10 and it goes to 0, you've effectively lost all your money. It doesn't matter how well you are doing at year 6. All that matters is when it closes, how well did you do at the end. Whereas if we create a token which represents that fund unit, and then we can sell that token to someone else, we can effectively cash out our position. Therefore, at year 6, I might say the fund units are 20 times their original value, 20 times is pretty good, I'll take that return and I sell it to someone else. I don't need to wait 10 years, I've cashed out and I've taken my profits. That is absolutely insane. If you understand venture capital, you'll get how big that is. If you don't, the best way to think of it is one of the best investment classes in the world has a big issue. You can't take your money out for 10 years. How much worse does it sound now? But what if I change that? What if I say that instead of 10 years, it might take you a week to sell your tokens? Maybe a few weeks. I don't think there's going to be huge liquidity on exchanges. It won't be like Bitcoin where you can buy and sell every few seconds. But still, a few weeks versus 10 years. That is a gigantic leap forwards. Number 3 is no liquidity within the portfolio investments. With a venture capital fund, you are investing into company shares at the early stage. So that usually means they're in the private market and they are highly illiquid. That obviously presents an issue. Security tokens can create liquidity within the private market that the company's shares are in. That is huge. I'll give you an example to explain why it's so important. Let's imagine Company A as an example. Your fund invests into Company A at a very early stage when they're valued at just $10 million. 5 years later, and Company A has done amazingly. Now they are raising money at a valuation of $1 billion. So they've gone from 10 million when you invested up to 1 billion, which I can't even demonstrate with my hands, it's that high. Theoretically, your fund has made a 100 times increase on its investment, 10 million to 1 billion. But they probably can't cash out, as there may be no secondary liquid market. Your fund will probably have to wait until the company goes public. This could be 5 more years, or worst of all, it may never even happen. There are many companies that go from here all the way up to here and do brilliantly, and you think you've invested and you've done amazing, and then they never make it to the public markets, and that means you can never sell out. So even though, once again, you've done brilliantly for years, if you haven't done brilliantly at the end, it doesn't really matter because you didn't have liquidity and therefore you didn't have the option to sell. Therefore, Company A may crash in value and your fund has actually lost its original investment. It's not done well, it's actually done really poorly. If there were a liquid secondary market to trade Company A's shares, which security tokens can create, the fund may have chosen to cash out entirely. It may have taken a small amount of profits, or it may have done anything in between. The point is, once again, we have a situation where a company can do this and then crash. With liquidity, you have the option to buy in and sell out. They are incredibly important. Essentially, liquidity is the ability to choose what you want to do with your investment instead of having no choice. Venture capital is amazing for producing high returns. It's one of the best investments around, and yet it's getting less and less popular as even the big investors are switching to other types of funds. The reason is liquidity. Security tokens can potentially overcome this. on both levels. You have the fund units liquidity, which basically means you can buy in and out of the fund when you want, and you have liquidity within the fund's investments themselves, so the actual companies that the fund owns. That means the fund manager also has the opportunity to buy in and out of these company shares when he chooses. Overall liquidity on these two layers is incredibly impactful. And the final thing is opening up this asset class so retail investors like you and me may be able to invest as well. And importantly, that doesn't even rule us out if you can't partake during the early raise, because you may be able to buy their tokens on the secondary exchange at a later date as well.